Good afternoon, and thank you for joining us on our webinar today. Why Cash is Not King in Fundraising, Results from 1 Million Nonprofit Tax Returns. My name is Nathan Stelter. I'm the Vice President here for the Stelter Company, and happy to be here today and introducing our friend and presenter, Dr. Russell James. But before I do, I'd like to say just a few words about the webinar series that you're partaking in today. As an industry leader in plan-giving marketing, Stelter has always been committed to providing innovative solutions and education for our industry. And as always, we're happy to host this complimentary webinar today, as well as a whole slate of webinars throughout the year. Perhaps you've joined us already for one of our earlier webinars. Today is actually the 6th in our 2018 curriculum, and there'll be 3 more scheduled for the remaining part of 2018. Some of those topics to come include email insights and trends from some of our own experts here at Stelter in September, and then actually Joe Bull, a current American Council on Gift Annuities board member, past Charitable Gift Planner, or NCPP at that Partnership for Philanthropic Planning board member, chair, will be talking about tips for creating standard performance metrics for charitable gift planners. I think that comes up in December. As always, we'll send out invites prior to those webinars and as they approach. But if you're so inclined and want to pre-register, you can go to stelter.com/webinars and find all that information there, as well as archived webinars from this year and previous years. Now back to today's webinar, which is presented by Dr. Russell James. Russell James, who hopefully many of you have seen or heard in a variety of capacities, a professor in the Department of Personal Financial Planning at Texas Tech University. He directs the on-campus and online graduate program in charitable financial planning. Dr. James has published research in over 40 different peer-reviewed scientific journals and has been quoted on charitable and financial issues in a variety of news sources, including The Economist, New York Times, Wall Street Journal, CNN, MSNBC, CNBC, ABC News, U.S. News and World Report, U.S. Today, AP, Bloomberg News, and our own Chronicle of Philanthropy. We are honored to have him here with us today to share his most recent research, and without further ado, I will pass it on to Dr. James. Thank you.
All right, thanks so much, Nathan. Well, I'm really looking forward to sharing some of these new results with you today and giving you some of the details from this latest research. And I think you'll find a lot of it really practically useful. But before we jump into these results, I do have to give you a bit of a warning that the presentation today is perhaps a bit different than some other presentations that you've seen. And what I mean a bit by that difference is that as good as it is to hear what works for other people and what we like to call war stories, here we are instead going to cover a massive amount of data. Actually, we're going to look at results from over 1 million nonprofit tax returns over a 7-year period from 2010 to 2016 to see what actually works to increase fundraising results. Also, sometimes there's a bit of a difference in my presentations, which happens because, well, frankly, once you get tenure, then you tend to just say whatever you think is true, whether it makes people annoyed or not. So if there are some things that I share today that don't make your life easier, at least you can know that I warned you first. Also, one of the things that's a bit different is sometimes I have attended presentations that have been labeled best practices, but sometimes that's just a list of what big organizations do. And instead today, when we talk about best practices, we're actually going to look at what growing organizations do differently than others of their same size, rather than looking at big versus small organizations. Of course, sometimes another downside from having a professor is that you have to sit through a little bit of talk about some of the theory and research behind why people do what they do before we get to the bottom line results. And so today I actually want to start with a little bit of a review of the psychology and economics of non-cash gifts. And the reason is, before we look at the actual specifics of how powerful non-cash gifts are at predicting long-term fundraising growth, I want to look at some of the reasons why, from experimental and psychological and economic research, we might in fact expect that asset gifts are going to be very predictive of not only current fundraising growth, but even long-term future fundraising growth. And so what I want to start with is a little bit of an understanding that comes from one of the sets of graduate courses that I teach here at Texas Tech University, which is in a field called behavioral economics or behavioral finance. And in behavioral economics, we look at lots of different ways in which people behave differently than we might expect them to behave if they were, say, just rational utility maximizing computers. And whether we're looking at different kinds of behaviors like loss aversion or anchoring or peer effects or hedonic adaptation, many of these weird behaviors that people engage in with money, they're actually just different expressions of the same underlying issue, which is that when it comes to choices and even our satisfaction, that is often driven not by objective amounts, but rather it is driven by relative comparisons. Now, this issue of relative comparisons is really important when it comes to learning to ask for gifts of assets rather than asking for gifts of cash, because fundamentally, from a relative comparison perspective, if you are asking for gifts of cash, you are asking small. What do I mean by this? Well, what I mean is very simply, wealth is not held in cash. Wealth is held in non-cash assets. And if you only understand how to ask from the cash bucket, that means you are going to be constantly asking from the small bucket. Now, depending upon the different methodologies we might use to estimate this, when we're looking at financial assets held by families, only somewhere around 1 to 3% of those financial assets are held in cash equivalents like checking accounts, saving accounts, money market deposit accounts. Instead, the vast majority of financial assets are held in forms such as stocks, bonds, retirement accounts, life insurance, and mutual funds. Now, this makes a difference psychologically because asset gifts can feel relatively smaller. For the wealthy donor, asking for the same gift from assets, where it's actually may just be a pretty small share of total wealth, rather than asking from disposable income, where it might be a really large share, can change the perception of how much you're asking for or how big of a gift that you're asking for. If you ask me for cash, my natural comparison is to think about the $5 I just spent at Starbucks out of my disposable income. But if you ask me for assets, my natural comparison point is the total wealth holdings that I have. There was a really cool experiment that showed the power of this, not in a charitable giving context, but in a fun kind of experiment where shoppers coming into a grocery store who agreed to participate in an experiment in exchange for receiving a free chocolate bar, they were randomly assigned to answer questions either about what was in their wallet or purse, such as, do you have any cash? Do you have any credit cards? Or they answered questions about, do you own any stocks? Do you own any bonds? Do you own any certificates of deposit? And then they just looked at, after they were asked those questions, they said, go ahead and do your shopping trip. And then they looked at their receipts after the shopping trip. And what they found was that people who had been asked the simple questions about owning stocks, bonds, or certificates of deposit, they actually spent 36% more in their subsequent shopping trip. It's this idea that when we're reminded of our wealth, we actually behave differently. So another example of this actually comes up in charitable giving. And it's a simple expression of this reality that people who feel wealthy actually act charitably. The strongest predictor of donation amount in a large statistical study actually was not objective wealth, how much the person actually had. It was actually, what was more important was their subjective feelings about whether they were wealthy or not. We can actually change how people behave charitably just by making them feel richer. In one study, making college students feel a little bit richer by having them report their savings on a scale ranging from $0 to $500 rather than from $0 to $50,000 increase subsequent donations. So if you ask the college students, okay, report what your savings is, and you give them this scale that goes all the way up to $500, they're more likely to check the top level and say, hey, I'm doing really well. In fact, I'm above this highest level that's even on the scale. Makes me feel wealthier, also makes me more charitable when asked for a gift after that. Whereas if you make me report on a scale that goes up to $50,000, now I'm reporting at a much lower level of that scale, and I don't feel as wealthy, so I don't donate as much. Another example of this from research is called mental accounting. This is the idea that people attach labels to financial assets and then they treat them differently. Now, actually, the guy that won the economics Nobel Prize in economics this year specifically won it for this contribution. And the reason this is important for charitable giving is that once we get a donor to make that first gift from non-cash assets, that can be really powerful for future giving because it labels assets as donation relevant. When a donor makes a gift of a non-cash asset, that donor experience can recategorize that asset class as appropriate for future charitable consideration. And that makes a big difference for their future charitable giving. It's one of the reasons why it's important to understand that a $10,000 gift from securities is actually much more powerful than the $10,000 gift of cash, because if a donor's never given from securities before, that first gift from securities may cause them to relabel that entire category as being donation relevant. And we actually see this from experimental research, that when we expand the total number of budget categories for which a particular charitable donation was relevant, it actually increases the donations. So labeling is important in this area. You know, we've got lots of other experimental research on when people tend to give more and when they give less. And one of the things that we've learned from this experimental research is that people are much more likely to spend irregular, unearned gains on charitable donations, or actually luxury goods in general. One of the reasons is that if we frame a donation as an exceptional event, it removes it from comparison with regular disposable income budget items and increases giving. So irregular, unearned gains generate more giving. We see this again and again in experimental research. Why is that important here? Well, it's important because in the real world, irregular unearned gains, we call those appreciated assets. And if we can learn how to ask for gifts of appreciated assets, we're asking for gifts from a category that we know experimentally causes people to be more generous, causes them to be more willing to give. And so it's very important, not only for the immediate gift, but for long-term and making people more generous, to learn how to ask for gifts from technically irregular unearned gains, what we would call appreciated assets. There's also some kind of more theoretical, broad sociological research that suggests that cash is a bit antisocial, whereas gifts of objects, gifts of things, are more pro-social. And there's some really good research that's been done that show that reminders of cash tend to promote independence and exchange motives, that sort of market trying to gain advantage motives. They tend to reduce willingness to help and even reduce the willingness to make donations. Now, in contrast, gifts of objects tend to be pro-social. What do I mean by this? Well, let me give you an example. If you're invited over to someone's house to come to dinner, do you think it would be socially appropriate to show up at the door and say, hey, you've really gone to a lot of trouble to do this. I really appreciate all of your efforts and your invitation. Here's a $20 bill to help out with the expenses. We don't do that. Instead, we might say, bring a bottle of wine or bring a gift, bring an object to give. But it's considered socially inappropriate to bring cash. This is this idea that cash is a bit antisocial, whereas gifts of objects are pro-social. What that means is that they emphasize communal norms rather than these market self-interested exchange relationships, and that encourages giving. So we also have this separate factor that can be particularly important when it comes to explaining why receiving non-cash gifts predicts long-term fundraising growth, and that is receiving non-cash gifts can tell you a lot about the fundraiser's technical sophistication. Especially receiving complex gifts, that's more likely to happen at nonprofits that have technically skilled fundraisers. This greater level of financial knowledge can change the relationship between donor and fundraiser from a simple plaintiff asking relationship to one of advising and giving advice and suggestions. And this can lead to long-term fundraising growth. Now, just a quick self-promotion plug here. If you don't have or feel like you're lacking any of that technical sophistication to ask for gifts of assets, there's a free 65-video YouTube series. Here's a link to it that yours truly put together. You're welcome to go through all of those technical details that I share with my graduate students in our online graduate certificate in charitable financial planning. So feel free and jump into that if you have interest in those sorts of topics as well. And then finally, aside from all of the psychology and sociology and different theories on why these gifts of assets can encourage long-term giving, there's just the bottom line accounting economic reality that appreciated asset gifts are objectively cheaper. What that means is that once donors learn how to give appreciated asset gifts, they can give more at the same net cost, and that can drive long-term increases in charitable giving. What do I mean when I say that appreciated asset gifts are objectively cheaper? Well, what I mean by that is simply this. If we make a gift of cash, say write a check, we get a tax deduction. Maybe that's useful if we're itemizing or not if we're not. But if we make a gift of appreciated assets we've owned for at least a year, we get that same tax deduction, but on top of it, we also get to avoid capital gains taxes, which is valuable regardless of whether we're itemizing or not. Let me give you that a quick example of that. Suppose we've got a donor who gives $100,000 in cash. That donor gets a $100,000 tax deduction. At the federal level, that can be worth as much as $37,000. If instead that donor gives $100,000 of stock, say stock that they would have purchased originally for $10,000, they also get a $21,240 tax benefit because that's the amount of capital gains tax they were going to have to pay, and now they don't have to pay that tax anymore. The exciting thing is that that capital gains tax benefit, that is a benefit that is just as powerful even for those who are not itemizing. So if you've got donors who last year were itemizing, but this year because of the new tax law with the new higher standard deduction, they're not itemizing, well, that's actually a way that we can use to talk about making gifts from assets. If a donor says, oh, I can't use those charitable deductions anymore, you might say, actually, under the new tax law, there is still a way that you can get tax benefits from making contributions. Would you like to learn a bit more about that? And the way they can do that, among others, is to give gifts of appreciated assets, and they can avoid those capital gains taxes regardless of whether they're itemizing or not. And oh, by the way, I mentioned that those asset gifts were cheaper. They actually got even cheaper under the new tax law. And why is that? Well, under the new tax law, the federal capital gains tax rates didn't change, but for people who live in states that charge a state capital gains tax, which is about 80% of people in the country, their effective rates just went up dramatically. Why do I say that? Because last year they could deduct those state taxes, and this year they're going to be capped out from deducting those state capital gains taxes just from their property taxes that they're paying on their house. So they actually aren't going to be able to deduct those state capital gains tax anymore. That means they're actually paying effectively much higher capital gains tax rates. So for our same scenario of a person giving $100,000 of stock that they originally bought for $10,000, last year, if they were at top capital gains tax rates in the state of California, that gift would have saved them $7,227 in state capital gains taxes. This year, it's going to save them almost $12,000 by avoiding those state capital gains taxes. So the new tax law makes asset gifts even cheaper for those who live in states that have a state capital gains tax. In addition to that, one of the things to keep in mind about making these gifts of assets is that you do not have to change the portfolio when you make a gift of assets to a nonprofit. The reason why is this. If, let's say, I give $100,000 in stock to a nonprofit, I can immediately, the same minute, the same instant, purchase identical replacement shares of stock. So instead of taking that $100,000 of cash and giving it to the charity, I give the charity $100,000 of old stock. I take that cash and I buy brand new replacement stock. Now, what I have done by doing that is I haven't changed my portfolio at all. What I have done is I have wiped out all that capital gain from my portfolio. Now, for those of you who are into the technical side of this, you may be familiar with a thing called the wash sale rule that makes you wait 30 days before you buy replacement stock. That does not apply here. That applies to lost property. We never donate lost property. Here we are donating gain property. We're donating appreciated assets, so we don't have to wait 30 days or 1 day or 1 minute. We can just do this immediate swap, so we don't change the portfolio at all, but we wipe out all the capital gains tax from the portfolio. And oh, by the way, if you are working with a donor who wants to give to a charity, or you represent a charity that doesn't know how to take gifts of assets, say, well, my CFO doesn't want to deal with it. We have to get it, the certificate medallion, or there's all these other weird things that we have to do. We don't want to take gifts of real estate because we don't want liability, whatever the case may be. Don't worry about it. All you've got to do is to ship that through a donor-advised fund. There are, in fact, now donor-advised funds that will accept any kind of valuable asset, whether that be stocks or real estate or unharvested crops or a partial ownership interest in a racehorse or whatever other valuable asset you might imagine. So we actually can make this very simple so that the charity simply gets cash in the end, but the donor is still giving appreciated assets. There's actually more good news for charitable deductions in the tax law. There are higher state tax benefits with charitable deductions because of that new SALT cap. For some folks, the federal rates actually went up. And for those who are technically minded, in the last few years, high-income folks were getting their charitable deductions cut down by as much as 80% because of this thing called the Pease limitation. That's been wiped out. We don't need to worry about it anymore. And the income limits have been raised for gifts of cash, meaning that now donors can actually wipe out a higher percentage of their total income from donations than they could before. A final reason that I think is actually particularly important here as to why gifts of assets actually predict long-term fundraising growth is that gifts of assets reflect real donor-centeredness. What do I mean by that? Well, what I mean by that is, as I've just shared with you, for the donor, a gift of an appreciated asset is much more beneficial for them than a gift of cash. But for the charity and for the fundraiser, it's kind of a pain in the butt, right? It's more hassle to go through this process. And so this is really where the rubber meets the road. Are nonprofits, are fundraisers really donor-centered or not? Are they willing to engage in the extra work and hassle that it takes to process and encourage these gifts of appreciated assets that we know objectively benefit the donors more than gifts of cash, when we know it's going to be more of a hassle for the fundraiser and potentially for the nonprofit? And that's the reality where donor-centeredness leaves this realm of happy talk. Yeah, we all love donor-centered phrases, and enters the realm of where the rubber meets the road. And are we actually willing to do the extra work to help out our donors? It's real action and not just talk. And it may be one of the reasons why these organizations are growing faster, is that they're actually donor-centered rather than just talking the donor-centered talk. Well, so those are some of the reasons why we might expect that asset gifts will be predictive of both current and future fundraising growth. But of course, if all you want is results, that is more fundraising growth, the precise cause might not matter to you. So let's get into these results and see exactly what we found. Why is this new data such a big deal? It's such a big deal because we've never had access to the data in this form before. It was just a few months ago that the IRS, for the first time, released this data in a machine-readable format that we could analyze with the sophisticated data analysis software. Before, if you wanted to get the IRS Form 990, you could ask for those one at a time, and they came in a PDF image. Well, frankly, nobody's got time to type in all that data for 1 million different tax returns. But now we've actually got it in machine-readable format, so we can analyze all of this data using this sophisticated data analysis software. That just happened a few months ago. We now have all of the e-filed Form 990s from 2010 forward, including much of all the way up to much of 2016. This is over 1 million tax returns from over 200,000 nonprofit organizations. So it's a massive, massive amount of data. Very exciting for data wonks like me that are interested in what really works. All right, so let's look at some of the results, and let's start out super simple. And what I want to start out with is a simple comparison. That simple comparison is this. I'm going to break nonprofits into 2 groups and 1 subgroup. Those 2 groups are, 1, nonprofits that receive only cash gifts. That is, all of their fundraising comes from cash. And then we're going to look at nonprofits receiving any kind of non-cash gifts. And then for a third category, this is just a subgroup of that middle category. These are nonprofits that specifically, among all of their other gifts, receive securities non-cash gifts, okay? So those are our three groups. We've got group 1, group 2, and kind of a group 2A here that is a subgroup. Now, what I want to share with you is a real simple comparison. We're going to look at the 5-year average growth in total fundraising. And here we're looking at their growth in fundraising from the year 2010 to the year 2015. And for this analysis, we're only going to look at nonprofits that are raising at least $1 million a year back in 2010 when we have our starting point, okay? And we're going to look at what is the average growth rate in these three categories from 2010 to 2015. Now, keep in mind that from 2010 to 2015, the inflation rate combined was about 8.5%. And I'm just going to share with you the raw dollar growth rate here. So 8.5% is what it takes to just tread water. Now let's look at the growth rate of these organizations. Let's first look at organizations that only received gifts of cash in 2010 and 2015. Those organizations on average grew 11%. Now remember, we've got about an 8.5 to 9% combined inflation rate over this period of time. So what's happening in those organizations that are only receiving gifts of cash? They're essentially just treading water. They're just barely keeping up with inflation. We look at the middle category. These are organizations that in 2010 and 2015 received at least some of their contributions from some type of non-cash gifts. On average, those organizations grew 50%. If we look at organizations, a subcategory of that middle category that received some types of securities gifts, those organizations grew 66% on average. Their fundraising grew 66% on average from 2010 to 2015. This is a massive, massive difference from just knowing one thing. Did you get any gifts of securities? Yes or no? That tells me whether you're growing at a 66% average rate for a 5-year growth rate or just an 11% growth rate when we've already got about 8.5% inflation. So that's the first result. Now, it's fine to be skeptical on these things. Let's dive a little bit deeper because maybe there was something special about the year 2010 to 2015. I just looked at that 5-year time period because it's the longest period of time that we can look at that we have 100% complete data for. So let's take a look instead at the 3-year average growth in total fundraising among these categories. So we can look at 3-year growth rates from 2010 to 2013, and then we can look at 2013 to 2016. We can also look at those middle categories of 2011 to 2014, 2012 to 2015, and guess what? It doesn't matter. Any 3-year period you pick, there are massive, massive differences in growth depending upon whether the organizations are only receiving gifts of cash or if they're receiving gifts that include gifts from securities. So again, if you're in that only cash category, your growth rates on average are going to be 5%, 1%, 2%, or even 0% for those 3-year average growth rates. If instead you're in that group of organizations that receive securities gifts, your growth rates are 3-year growth rates are 44, 42, 39, 33%. Massive, massive differences that we're seeing here in organizations' fundraising growth rates. Okay, well, so we see these big differences, but maybe this is just because organizations that get non-cash gifts are bigger. So what do we do to take a look at that? Let's look at organizations just within different categories of fundraising levels. And here we look at columns of different sizes of organizations, sizes of fundraising. And we'll start with really small organizations, those that are only raising $100,000 to less than $500,000. And within those organizations, that's our first column here, still a massive, massive difference in the 5-year fundraising growth between organizations that only receive gifts of cash and organizations that receive gifts of securities. We bump it up to organizations that were fundraising in 2010 between $500,000 and $1 million, same set of differences. Organizations raising between 1 and 2 million, we see this same kind of separation. Organizations raising between 2 and 3 million, same sets of results. Between 3 and 5 million, same sets of results. And between 5 and 10, and finally, those organizations raising 10 million and above. We continue to see this separation. Now, you might wonder how come the percentages are actually larger for the small organizations? Well, it's because it's a lot easier to double and triple the fundraising at an organization raising $100,000 than at an organization raising $50 million, right? So the percentages might be a bit smaller, but we still see major, major differences in these categories, regardless of what size of fundraising organization we are dealing with here. Now, we've been looking at comparing organizations that raise some gifts from securities or other non-cash gifts versus raising nothing from non-cash gifts. But what happens when nonprofits don't move from none to some, but they actually shift the share of cash or non-cash gifts that they receive? So we're now looking at a change in the percentage of cash or non-cash gifts that they receive. So here's what happens on average in the same year when gifts shifts from cash to assets. What happens on average at an organization that increases its total contributions? It increases the share of total contributions it's getting from cash by 10%. What happens on average is that total contributions will actually fall by 13%. Now let's compare that to what happens in the same year when organizations shift their total contributions to securities by increasing total contributions from securities by 10%. What happens in the same year is that total fundraising grows by 18%. When we look at real estate, when the total share of contributions shifts to include 10% more real estate, we get a 26% growth in overall total fundraising in that same year. So this is looking at over 750,000 e-filed IRS Form 990s from over 200,000 organizations, looking at all years of data from 2010 to 2016. When organizations shift away from gifts of assets towards more gifts of cash, their total contributions fall. When they shift more towards securities and real estate contributions, their total combined contributions go up. So, does the type of non-cash asset matter? Well, the cool thing about this new data is that we're actually able to do a deep dive into specifically what kinds of assets are being contributed, and the answer is yes. It does make a difference what type of assets are being given. If we want to look at the same year effect of that 10% ratio shift, if organizations are shifting from cash to gifts of non-cash like books, food, collectibles, and what are called uncategorized, these can be things like, for example, the value of software and other things that are contributed, that actually doesn't make any difference. That's essentially the same as cash. If the organization is shifting towards non-cash gifts like cars, boats, household goods, that makes a little bit of a difference. It's a little bit of a help. This also includes art or drugs. By the way, the drugs, that's mostly contributions to those serving foreign audiences from the pharmaceutical industries. What about organizations that are instead shifting towards gifts of publicly traded securities? That is where we start seeing a significant bump here, but the really big bumps come when they shift to larger asset types, that is, asset types that represent substantial wealth. That is real estate and non-publicly traded securities. What do I mean by non-publicly traded securities? I mean things like private subchapter S corporation, limited liability companies, privately held companies, LLCs, these types of non-publicly traded securities. And when you get into those types of assets that represent real wealth, we get really big differences in the impact that it makes on the fundraising for organizations. Well, okay, so what are some other objections here? You might say, yeah, but my organization is different. We are really big and sophisticated. This doesn't apply to us. And I'm thinking, okay, how big are you? This is what happens at organizations that are raising $50 million or more a year. We see the same results. Or maybe you want to look at the very largest organizations. These are organizations raising $500 million or more a year. And what happens when they shift to more securities versus shifting to more cash? We see the same basic result. We may get into this issue of saying, yeah, but our sector is different, so you wouldn't understand what's different about us. Okay, what's your sector? Here's the results from 18,000 arts and cultural nonprofits. Here's 29,000 education nonprofits. Maybe education's too general for you, so here's over 4,000 colleges and universities. Here's about 15,000 healthcare nonprofits. Here's about 5,000 specific disease nonprofits like cancer, heart, arthritis, birth defect, AIDS, Alzheimer's. Here's environment nonprofits, a little over 4,700 of those. Here's housing and shelter nonprofits. Here's recreation, sports, and camps nonprofits. Here's human services like Red Cross, Salvation Army, YMCA. Here's animal and wildlife nonprofits, a little over 4,000 of them. Here's business or community development nonprofits. This is going to include your donor-advised funds. Same result that we get here. Community and public foundations, this is where we would get our donor-advised funds. International development relief organizations, here's the results for over 4,000 of those organizations. How about religious nonprofits? Churches don't have to file these, but for any religious nonprofits filing 990s, we get the same result. Bottom line is this: shifting to gifts of non-cash assets drives total fundraising growth in every nonprofit sector at every fundraising size in every time period, whether it's the same year or 3 years later or 5 years later. Now, this is important to learn how to talk about gifts of assets. I hope I've convinced you of how important that is. How do we do this? How do we talk about gifts of assets? Well, let me share with you some experimental results in that. Should you talk about these great tax benefits that I just mentioned? Well, I'm going to tell you a little bit of reasons why you want to, and this is a big deal because people sometimes misunderstand research that comes out in this field. And what I mean by that is this: you'll have a group that sends out a survey that says, we want to know why donors give, and so we'll ask them why, and they give donors lots of reasons. Do you give because you want to change the world, because it reflects your values, because you're a good person? Or do you give because you want tax benefits? And they'll get the results back and they'll say, looks like nobody gives because they want tax benefits. And as a researcher, I got to say, you can't test that in that way. People are going to report their socially approved motivations. They're not going to report these antisocial or not pro-social kinds of motivations. You got to test it in a different way. How do you test it? You test it like this. Here's a group of over 1,000 folks. We randomly assign them to one of two descriptions of making a gift of stocks or bonds to charity. And it turns out that people are more interested in making a gift if we reference the tax benefit, that they can avoid capital gains taxes by making a gift of stocks or bonds to charity. In a completely separate study with almost 2,000 folks, we found similar results. Here's where we randomly assigned, split them into 3 groups, randomly assigned them to receive one of 3 descriptions of a charitable gift annuity, and we asked them who's interested now in this kind of a gift. And we see that if we mention the tax benefit, and in particular, if we lead with the tax benefit, we get a much higher share of people who say, yeah, I'm interested in that, and a much lower share of people who say, no, I'd never be interested in that. What we did with this group is we actually then rotated them, and now we're using a description of a retained life estate, also known as a remainder interest deed. Again, same description, one with no reference to a tax deduction, one with the reference at the end, one with the reference to the tax deduction at the beginning. We got this, the only difference is here we're rotating the groups, so the group that had the reference to the tax deduction at the beginning before now doesn't have any reference to the tax deduction, and vice versa, and we see we get the same result. By the way, if this particular charitable giving vehicle doesn't make any sense to you, then you need to watch some of my videos online, or connect with me on LinkedIn, and I'll send you those connections so you can learn about this cool technique. We then once again spun the wheel one last time, and here's the description of the charitable remainder trust, where we had one group, no reference to a tax deduction, one where we bring it almost all the way to the front and then all the way to the front, and we see the same results. What's the best phrasing to describe tax benefits? It turned out we tested a bunch of these different phrases. Didn't make a big difference. It just was always better that we reference the tax benefit instead of just asking people about if they want to read about giving stocks. Mentioning tax benefits works, but keep in mind it isn't the reason that people give. You don't want to destroy the pro-social nature of the act, even if you're referencing the benefits. Also, when we're talking about these kinds of gifts, social norms are powerful. We want to see, do people like me do things like this? Recent research out of a university in Sweden finds that it's powerful to talk about what other students in the country did, but it was more powerful to talk about what other students at that university did when trying to raise gifts from students at a particular university. Social norms are more powerful when the examples are like me. Here's a quick example using a charitable gift annuity. We tested whether you should talk about what you can do with a gift annuity or what Sarah did with a gift annuity, and it turned out it was better to talk about what Sarah had done with a gift annuity. And so that social norm is powerful. We then tested it with a picture of Sarah, and our picture of Sarah actually didn't work. We couldn't figure out what's going on. How come adding this picture of Sarah didn't work? So we tested a bunch new Sarahs, and when we tested our large group of new Sarahs, I'm now putting a box around the best performing Sarah depending upon the age of the respondent. When we were able to age match the picture of the donor with the respondent, people were much more interested in making the gift. So the idea is that we want to age match if we can. Why? Because we want to say that people like me make gifts like this. If we can't age match, then we just want to show them a different picture or no picture at all. The question is, do people like me do things like this? All right, so I want to end on this. I think that these results are so powerful that they suggest some new strategies. What are some new strategies? Well, number one, keep in mind accepting non-cash gifts is safer today than it was 10 years ago. I already mentioned if you don't want to take that gift directly, if it's valuable, you can ship it through a donor-advised fund. There are funds that will accept about any type of valuable assets now. There's also some new legal developments, like new instruments called single asset LLCs that help protect nonprofits from any liability. Fundamentally, the reality is this: non-cash gifts are more important, but I don't want to ignore the fact that they're also more work. So here's the choice that organizations have. They need to make the decision. Are fundraisers going to be given the extra tools and the extra rewards to do the hard work of raising gifts of assets? Or do organizations say, let's just hit the easy button of cash only. Let's not give any extra credit to fundraisers that are doing the hard work of raising gifts from assets, and let's stay in this no growth, slow growth category of cash only. That's bottom line, the hard choice that has to be made. Well, I hope some of this has been of interest to you. I'm actually really excited about some of these new results and the magnitude of the difference that it actually makes for nonprofit organization fundraising if they are raising gifts from non-cash assets. Hope some of this has been of interest, and so I want to take a moment now to see if there's any questions or thoughts that anybody happens to have about this topic. So I'll end there.
Yeah, absolutely, Russell. Thank you so much. We do have a handful of questions that have come in. Before I get to them, though, there was one question that came in from Jen, and she was asking about if you could give some examples. And Jen, I didn't see when you sent that in, so I'm not sure what topic Russell was speaking about when you sent it in. So if you could just write in just a little more clarity on your question, and then we'll see if Russell can answer that. Jeanette sent a question in, and she says, despite understanding the tax benefits of giving stock over cash and the ability to repurchase the stock with a new higher cost basis, donors are often reluctant to give stock. Do you think that they're emotionally attached to their investments? And how do we help them move from cash to stock gifts?
So I certainly think, as the question suggests, that it's important to let donors know that they don't have to change their portfolio at all. That if they own 10,000 shares of Apple before this, they should own 10,000 shares of Apple after this. And so we may want to talk about this just in the sense of this is a way to wipe out all the capital gain from the shares of Apple that you own. So it may be just an issue of framing this. I think it's actually a pretty valuable insight from this question that some donors are emotionally attached to their stock positions, and so to the extent we can frame this as not changing that ownership, that they're still going to own those shares of stock. It's just that we're going to wipe out all the capital gains tax from that stock, that it may help. So we may be able to help in the way that we frame the discussion and the description of these kinds of gifts as simply a way to not change the portfolio, but wipe out the capital gains tax from the portfolio, or at least wipe out the capital gain from that share of the portfolio. And it may help to give examples of other people like them who have done this same kind of transaction. And you may even give examples of other people who have emotional attachments to their position, and so they didn't want to change their stock ownership position in some company, and so instead of changing their position, they just did a swap that kept their same position but eliminated all the capital gain from their position, from their stock ownership position. It's really a free tax benefit that people give up every time they give cash. And so from a financial planner perspective, we always encourage folks, if you've got appreciated assets, you want to give those first.
Thanks, Russell. We have a question from Stacy, and you see me flipping through the slides. She was wanting some more explanation around one of the slides that you had presented about asset gifts just got even cheaper for many.
Yes.
So I was going to try to find that for the audience, and if you know what she's talking about.
Yes, absolutely. So okay. What this is the big difference is this. When we look at that 2017 category, and so here what we're looking at is the bottom underneath the plus sign, the extra benefit we get from giving assets. Last year, if I gave that asset, it did two things. I was able to avoid the 13.3%, that's the maximum capital gain tax rate for the state of California, okay? But I also lost a benefit, and that benefit was if I paid that state tax, I also got a federal deduction for paying that state tax, okay? This year, that benefit for most any of your donors you're going to work with, that benefit's been completely wiped out. Now, technically, it's capped at $10,000 for a married couple, but frankly, if you're dealing with these states, you know, people are already going to be capped out just from their property taxes that they're paying on their houses. So that means last year, avoiding those state capital gains taxes came with both a penalty, and which was the state taxes, and a benefit, which was the federal deduction. This year, we get that same penalty, but we get no benefit. So now it's a much bigger deal to avoid those state capital gains taxes, because those state capital gains taxes are now so much more painful than they were last year. This was Trump's I love you note to the states of California, New Jersey, and a few others, New York, that have these high state tax rates, where folks in those states are now facing much, much higher effective combined capital gains tax rates than they were last year. Now, the income tax rates, we may have a little bit of an offset, right? Because we got a little bit of a reduction on the federal level. We get a little bit of an increase on the state level. But there's no offset at the capital gains tax level because there was no reduction in federal capital gains taxes. All we got is this big bump in state capital gains taxes, at least their effective rates, because we got the federal deduction effectively wiped out for at least any of the donors we're going to be working with. It actually makes everything that we do in planned giving so much more powerful this year than it was last year, because being able to avoid capital gains taxes is much more powerful this year than it was last year, at least for those 80% of Americans that are living in states that charge taxes at the state level for these kinds of capital gains taxes. So that's why these gifts are actually even cheaper this year than last year on that capital gains tax side of things.
All right, we've got probably a couple more, a lot of great questions. We'll pass these on to Russell afterwards. A lot of great kudos, Russell. I don't know if you'd seen these, but there's some great kudos on the presentation. Again, loving the
Thanks.
visuals. Definitely have upped your game the last couple of years on the visuals here. A couple quick ones. Good friend, hey, Terry Balco on the call here. Do you have any statistics regarding gifts of family businesses and opportunities in that sector? And
so just a quick response on that. What we have when it comes to family businesses is the information on the 990 is simply non-publicly traded securities. And so that's going to, we've actually got a little bit more differentiation there. We can sort of look at LLCs or closely held businesses, trust, that sort of thing. So I would say for the most part, that's going to be in the results where you saw the non-publicly traded securities. It's going to be that's where the family businesses show up. So yes, those were super, super powerful at predicting same year and long-term growth when we saw charities that were getting those kinds of gifts. Very, very powerful types of gifts because they represent big chunks of wealth.
I know we're getting close to time here, so thank you everybody for the continued questions. I know Liz here has asked a couple different questions, so let's at least get to one of hers. One of them that came in is, what are some strategies for incentivizing fundraisers to do the hard work of asset fundraising / evaluation?
Well, I think when we look at what fundraisers are doing, we know it requires extra effort, it requires extra training to be able to ask for these gifts. I think it makes sense for organizations to give a different level of credit if I have asked for a gift of assets or if I am able to raise money from a gift of assets. What I'm telling you is that for the organization to go and get a gift of $10,000 in securities, especially if it's the first time that donor's ever given non-cash gifts, rather than getting a $10,000 gift of cash, that is worth crediting. that is worth recognizing the extra work and how it changes the donor mindset and how it can predict long-term success for the organization. So I think it's worthwhile for organizations to give credit differently depending upon, did you learn enough about the donor to ask for a gift of assets? Or did you just make the simple, easy ask, the ask for a gift of cash? And I think it's worth a different level of crediting for people who make those gifts from make those asks from wealth rather than just from cash.
Thanks, Russell, so much. Just the wealth of questions that have come in. We are seeing a lot of kudos to you, like Nathan said. People really enjoyed the presentation. However, we are out of time, and we want to respect everyone's time. So if you do have additional questions, or you had the question that we didn't get to that you really would like an answer to, Russell has offered his email address. You'll see that on the screen. You can reach out to him. You can also reach out to Nathan or myself if you have questions about our webinar series. If you have questions about our products or services, you can visit stelter.com. And then one of the main questions we got was, can I watch this again and can I have the handouts? And the answer is absolutely yes. We recorded it, and barring any technical difficulties, it will be on our website by tomorrow along with the slides. That will be stelter.com/webinars. And then Russell also mentioned that he has this technical paper available. Russell, if you want to speak to that.
Yeah, so for those of you who are interested in these sorts of things, the final version of this paper has actually been accepted at a peer-reviewed academic journal, so it will be appearing in print in the fall. This is a link to an earlier version, but once that final version comes out in print in the fall, this link will also connect you into that link. So I will tell you that these are now peer-reviewed, accepted, and what will be later in the fall published results. So if you're trying to convince some of your leaders at your organization, you will have that published scientific paper available in the fall to add into the argument as to why these types of gifts are so important.
Great, thanks, Russell. And also, we will put a link to that, your technical paper, also on our website under the webinars and under our research area. So you can also find that there. Thanks again, Russell. We really, really appreciate your time today. I'm sure everyone that we had about, I think, 400 people logging in today, and I know that they really appreciated your time, and we appreciate everyone coming today and participating in the webinar. And we will hopefully see you next month at our next webinar. Visit stelter.com/webinars to register. Thanks, everyone. Have a great afternoon.